$10 billion was sold to investors as one of the safest bets in the world. It was packaged, insured, and stamped low risk by one of the biggest banks on earth. Almost none of it was safe. Much of it was never coming back. This is the story of Greensill Capital and the man who turned unpaid invoices into a global time bomb. A company that borrowed the name of boring, ordinary finance to hide enormous risk. When it fell, it helped bring down a 160-year-old Swiss bank. By the end of this file, you will see the single missing insurance policy that ended it all. And one question regulators still cannot fully answer. Was this genius that failed or a Ponzi scheme in a very expensive suit? Keep that in mind. The man at the center still insists it was neither. The story begins on a sugarcane farm in Australia. The Greensill family grew crops and often waited months to be paid for them. Young Lex Greensill watched his parents struggle, cash poor while waiting on buyers. That wait, that gap between work done and money paid, became his life's obsession. He trained as a lawyer, then went to London to work in finance. There he mastered an old, unglamorous tool called supply chain finance. The idea is simple. A supplier is owed money but must wait 90 days to be paid. A financier steps in, pays the supplier now, and collects from the buyer later. Everyone wins. The supplier gets cash. The buyer gets time. The financier takes a small fee. It is boring, low risk, and centuries old, and that respectability was the perfect disguise. In 2011, Lex Greensill founded his own firm to do this at scale. He dressed old finance in new technology and bold ambition. He had powerful friends. He had once advised a British prime minister. Doors that stay shut to most bankers opened for him with ease. Investors loved the story. A farm boy fixing an unfair system with cash and code. In 2019, Japan's SoftBank poured $1.5 billion in. Greensill was suddenly valued at $3.5 billion. The plan was even bigger. A $7 billion company, a stock market debut, global reach, 16 offices worldwide, a private jet, a knighthood-level rise. On the surface, a fintech fairy tale. Underneath, the foundations were quietly rotting. Here's how boring finance was quietly twisted into something dangerous. Real supply chain finance is short and safe. Money out today, back in 90 days. Greensill started stretching it. Longer loans, bigger sums, riskier clients. Then came a darker trick, financing invoices that did not exist yet, so-called future receivables, money lent against sales that had not happened. In plain terms, Greensill was lending against imaginary business. And a huge share of that money went to one man's empire, a steel magnate named Sanjeev Gupta and his sprawling metals group. Greensill lent his companies around $5 billion, one financier, one client, $5 billion of exposure, a single point of failure. But Greensill did not keep this risk. It sold it onward to other people's savings. The invoices were packaged into bundles and sold as investment notes, and the biggest buyer of those notes was Credit Suisse. The Swiss bank sold $10 billion of these notes to its own clients as low risk. Pension funds, companies, wealthy savers, all told this was a safe place to park cash. What held the whole tower up was not the invoices, it was insurance. If a borrower failed to pay, insurers would cover the loss. That promise made the notes feel safe. The entire $10 billion structure rested on those insurance policies. Remember that. The whole empire stood on one renewable promise. By 2020, cracks were spreading across every part of the structure. Greensill's own German bank was stuffed with loans to Gupta's steel empire. German regulators grew alarmed. Too much risk pointed at one fragile borrower. Then a virus shut down the world. Supply chains froze. Cash stopped moving. The most fragile borrowers were suddenly the most likely to fail. And then the detail from earlier returned, the insurance. Greensill's main insurer decided not to renew the policies covering billions in loans without insurance. The safe notes were suddenly not safe at all. Greensill went to court to force the insurer to keep covering it. It lost. The keystone was pulled. Now the whole tower had to fall. For a brief moment, it looked like a rescue might still be possible. A giant American investment firm circled, ready to buy the healthy core of the business. Advisors believed the good parts could be saved from the wreck. For a few days, the collapse seemed contained, survivable, almost ordinary. Then the rescue buyer looked closely at the books and walked away. What they saw was the truth the packaging had hidden. The safe notes were stuffed with loans to one shaky empire backed by invoices that did not exist. On March 8, 2021. Greensill Capital filed for insolvency. 16 offices, billions in deals, gone in a matter of weeks, and the damage did not stay inside Greensill. It exploded outward. $10 billion of Credit Suisse funds were frozen overnight. The safe investment thousands of clients trusted was suddenly worth a fraction of its promise. Credit Suisse had to admit it may never recover billions of its clients' money. The steel empire that borrowed $5 billion staggered toward its own collapse. Thousands of steel jobs across several countries hung in the balance, and this is where the story stops being simply a business failure. British politicians had helped open doors for Greensill at the very top of government. A former prime minister had personally lobbied officials on the company's behalf. Text messages, private meetings, quiet requests for special access to public money. The lobbying scandal became one of the biggest political stories in Britain. Meanwhile, investigators asked a harder question. Was any of this a real business at all? Members of Parliament put it bluntly. Was Greensill a fraud or a Ponzi scheme? In a Ponzi scheme, new money is used to pay old promises until the new money stops. Critics said Greensill looked dangerously close to that shape. New notes were sold partly to keep the old structure standing. Lex Greensill rejected this completely. Not a fraud, he insisted, not a Ponzi scheme. He blamed the insurers. Pull the cover, he argued, and any lender would fall. And there is a real point buried in that defense. The business model was legal. Supply chain finance is a genuine, useful tool. Greensill did not invent the concept, but investigators kept returning to the invoices that referred to sales never made. You cannot insure a delivery that never happened. You cannot safely sell a debt that isn't real. The deeper you looked, the more the safe notes dissolved into wishful thinking, and the banks and insurers who were paid to check, they looked away too. Credit Suisse had marketed these as safe. Its own risk checks failed. The Swiss regulator later found the bank had seriously breached its duty to manage risk. Greensill's collapse became one of the wounds that helped kill Credit Suisse itself. 2 years later, the 167-year-old bank was swallowed by a rival in an emergency rescue. A firm that packaged farm invoices had helped topple a pillar of global banking. So decide for yourself. What was Greensill really? Option 1. A genuine business that grew reckless and got unlucky with a pandemic. A real tool, stretched too far, undone the moment its insurance vanished. Option 2, a structure that only survived by selling new risk to cover old risk, dressed in the respectable language of boring finance so nobody looked underneath. The courts and regulators are still untangling which version is true, but the deeper lesson does not depend on the verdict. The most dangerous risk is the risk that has been labeled safe. Everyone trusted the packaging. Insured, bank-approved, boring. Surely boring can't be dangerous. Investors trusted the bank. The bank trusted the insurance. The insurance was about to vanish. Politicians trusted the founder. The founder trusted his own story a little too much. A whole chain of trusted names, each assuming someone else had checked. That is how $10 billion of safe money quietly turned into smoke. Greensill did not collapse because supply chain finance is evil. It collapsed because a boring, safe label was wrapped around something that was neither. The scariest frauds and failures rarely look scary. They look responsible. They look dull. Nobody double-checks dull. That is exactly where the danger hides. One detail still hangs unresolved. Billions of that money have never been recovered. More than $2 billion is still missing from investors' accounts today. The paper trail runs into empty warehouses and invoices for goods that never moved. So you be the jury, reckless genius, or a Ponzi scheme in a very good suit. The regulators are still deciding. You don't have to wait. Say your verdict in the comments. And the auditor whose name keeps appearing across these collapses, that story is the next file.